Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market update and U.S. market preview right here from the central London studios of Core TV. I'm Martin Baccardax. I'm the London Bureau Chief here at TheStreet.com. I'm going to take you through those 5 things you need to know before the bell, as we do each and every day. And as we do each day, we're going to start with European stocks, but it really is a global story, and for that matter, it's a Fed story. It is the great unwind, and it is going to begin as of next month. Probably the biggest experiment in the history of global financial markets, and I am not exaggerating when I say that, is about to come to a very slow conclusion, and that, of course, is the $4.5 trillion worth of quantitative easing that the U.S. Federal Reserve put into place at the peak of the financial crisis in order to steady the ship, lower risk-free rates, and entice investors out into the real world. It's had mixed success, it has to be said. It's been experimented with the Bank of Japan, the European Central Bank, and the Bank of England as well. I could go through the details as to why they haven't worked in each of the economies, but I can say that in the United States, it does appear to have had the positive impact that it was designed. There are some exacerbations, of course, and asset bubbles along the way, but it's coming to an end. That's what Janet Yellen signaled last night when she said the unwind was going to begin in October, probably as the result of about $10 billion a month, rising to $50 billion relatively quickly, still relatively small. At the same time, the Fed said it's going to raise interest rates once more this year and 3 times next year if the economy continues to improve. Global market reaction, relatively mixed, it has to be said. Asia was flat. A slightly weaker yen pushed the Nikkei 225 into positive territory for the second consecutive session. And what we saw here in Europe were cautious gains, relatively steady. My suspicion is that investors like European stocks versus American ones at the moment, because the ECB is still going to continue quantitative easing, and that puts cheap money into the frame for a longer time period than it will in the United States, and that is going to increase the attractiveness of European stocks. Wall Street futures are dangling a little bit lower right now, but nothing really significant. Banks were the big advancer here in the United States, here in Europe. Now that might offer you a really interesting play. If cheap money is in place from the ECB, but European banks are going to take advantage of a steeper global yield curve, i.e. a larger difference between short and long-term rates, you may be able to leverage a little bit of extra return from European banks versus American ones. And I do believe that's being played out in the market today. Definitely a trade to keep an eye on. We're going to move on now and talk about Google, because that's an enormous story in the marketplace as well today. The online search firm said it is going to buy basically 2,000 engineers in a team that creates Pixel phones at HTC, which is a Taiwanese maker of handsets, for around $1.1 billion US. It's going to take the whole team under the Google arm, and it's going to use them to help further the company's ambitions in the hardware space. It's a really interesting story. Google isn't going to buy any manufacturing facilities, not going to buy any plants, it's not buying a division as such, it's simply buying a team of 2,000 people. That is going to, again, come under the Google umbrella and hopefully allow them, not necessarily to advance their smartphone division, which I think a lot of people see, but maybe more likely its home division, in the ways that augmented reality, artificial intelligence, and those other things are going to be intertwined with the Internet of Things and, of course, all of the activities that we take part in at home. I do believe that that is probably the larger arc of this story. Now, the Android software that powers a lot of the handsets that are sold in the world, more so than is the case with the iPhone, are something that is, the technology has a mismatch in many respects. Not every Android works correctly in the same fashion, and they don't speak to each other with the kind of symmetry and singularity that Apple devices do, which is why Apple is able to augment the sales of its iPhone into things like the iPod, the iPad, the HomePod, etc., the watch. You get where I'm going. So if Google is able to do that by streamlining the Android operating system in a similar fashion to the iPhone OS, it may be able to have a better suite of products that will connect in its push to the home entertainment division, into that market of home entertainment and augmented reality. So this is an interesting play. And again, I don't think it's based on handsets or some sort of Google push into the handset market. I mean, Pixel phones, there were 550,000 of them shifted in the first quarter of this year. 78 million iPhones were shifted in its last fiscal quarter. So there really is no competition as far as that's concerned, and the iPhone X is the hottest ticket on the market right now. So I do believe that it's a slightly different perception where Google is going to move into that home space, but nonetheless, investors need to take heed. Google's tried this before. They bought Motorola Mobility for about $12.5 billion in 2013. 3 years later, they had already lost $8 billion, and they dumped it to Lenovo. So their moves into hardware have had mixed success, and they certainly have come at a cost. This is a lot cheaper. It seems much better timed, it has to be said, and it's certainly going to get a lot of attention from people like Amazon and for people like Apple and others that are competing for that very lucrative and fast-growing home space. Now, another story that's fast-growing, but for all the wrong reasons, are cyber attacks and hacks. And of course, we discovered last night that the Securities and Exchange Commission is the latest victim of a cybersecurity breach. In 2016, the SEC said hackers got into its Edgar filing system and were able to take advantage of the information that's in there. For those of you who aren't familiar, effectively, all listed U.S. companies have to file significant changes in their company's activities through this system, either through quarterly earnings, takeover, mergers and acquisitions, CEO resignations. Anything that is material and market moving has to be filed through the system first and then disseminated fairly and equally to investors at exactly the same time. This is designed to give no investor any unfair advantage over another when it comes to material information. So this database needs to be secure if financial markets are to work correctly and in a fair and flat playing field fashion. So the fact that it was hacked is significant enough in and of itself. Now, the SEC said it found out about the hack in 2016, but only last month realized that the breach may have resulted in some insider trading. In other words, the hackers could have used the information to buy and sell securities based on that information before anybody else knew it, and therefore make a tidy profit. You can see straight away how lucrative that might have been if that was the case, and the SEC is still looking into it. You can imagine if they get to the end of it, there's going to be criminal charges as a result. But it nonetheless reminds us of the vulnerability that companies, governments, agencies, and everybody else has to these cybersecurity breaches. Equifax, of course, we know their shares have lost about a third of their value since they revealed the breach in 2017. And now, of course, there are criminal investigations into the sale of securities by certain Equifax executives, and also increasing questions even at a government and Senate hearing level as to what the company knew and when it knew it. FedEx, only a couple of days ago, told us that its quarterly earnings were going to be weaker than expected owing to a cybersecurity breach at its TNT Express unit in the Netherlands. WPP, the biggest advertising company in the world, based here in London, was the victim of a cybersecurity attack with the WannaCry virus earlier this year. It's going to trim their first half earnings as a result as well. All kinds of companies across the spectrum are falling victim to this, and it seems to be happening with an ever-increasing and troubling frequency. And if you can get into the SEC database, it's hard to imagine what you can't get into. Cybersecurity is going to be a major issue for companies in terms of profitability and in terms of their reputation going forward. This story has legs, it simply isn't going away. Let's get back to the Fed, though, because I want to talk about Janet Yellen. I thought that press conference yesterday was absolutely riveting and really, really telling with respect to the thought process of not only the chairwoman of the Federal Reserve, but also of her colleagues. I want to stick with one particular statement that she made when she discussed the so-called mystery of low inflation in an environment where the economy is growing at a 3% clip and the unemployment rate is at the lowest it's been in about 16 years. She said that she will not say that the committee, the Fed Open Markets Committee, clearly understands what the causes of that are. They're not really understanding why it is that inflation sits at 1.4%, unemployment sits at 4.1%, and the economy is growing at 3%. Throw it all into the typical economic models, and you should have much faster inflation and therefore much higher base interest rates. The fancy equation that many people will talk about is called the Taylor rule, which looks at ways in which unemployment should dictate base rates from any particular central bank. It's simply not applying right now, and I do believe that that is a result of major changes that we're seeing in the way that we consume goods, the way that we pay for them, and indeed the way that we live our lives that is entirely different to the way that we did even 10 years ago. Ms. Yellen made a reference to the fact that she expects higher gasoline prices in the months ahead as a result of the disruption that's being caused by Hurricanes Irma and Harvey. But here's the deal. How many of us are driving in the same way that we used to? Self-driving cars, Uber, and everything else are on the horizon in ways that are going to change the way that we travel completely. We're buying more online. We're entertaining ourselves more at home. We're not going to the movies. We're not going to restaurants. When you look at things like Blue Apron delivering gourmet meals to our doorsteps, when you look at Netflix giving us the latest in entertainment that's better than anything in the cinema right to our laptops, when you look at the ways that you can purchase just about anything at the click of a mouse, and if you don't like the price, you can click again and find something cheaper. None of these are inflationary dynamics in a global e-commerce economy. And I simply can't understand why this isn't being factored more deeply into Fed rate projections. They're talking about 3 rate hikes in 2018, and they may absolutely be right. But the underlying assumptions that inflation and unemployment should be linked because they're going to raise consumer prices in some sort of symmetrical way, I simply think is incorrect in the 2017 context and is going to become more incorrect in the months and years ahead as the dynamics that we are talking about become more entrenched in the way that we live our lives. The Taylor rule simply isn't going to apply anymore. It made perfect sense a few years ago. The kaleidoscopic changes that we're seeing in the ways that we purchase, consume, and search for goods has made that pretty much irrelevant, and I'm really amazed that it was part of the discussion yesterday. Nonetheless, we are seeing a 70% chance of a rate hike from the Fed now as a result of futures prices in December, and the market doesn't seem to be fighting against the Fed's consensus. That's for the moment. We'll see if that lasts in the weeks ahead. Now, Wall Street caught a little bit lower, as I say. Dow is going to get clipped by about 3 points. That's next to nothing, really, when you consider the dynamic that we're seeing right now in the global financial markets as a result of this balance sheet unwind and the Fed rate hike signals. I'm going to be interested to watch tech stocks today for a whole host of reasons. Certainly the Google acquisition with HTC, but also the reports that we're seeing with respect to malfunctions in the Apple Watch, the Series 3, that could have been the must-have gadget for this Christmas season, if indeed it is working as expected. So we're going to watch that. And there's also been, as you know, a very tight correlation between the FANG stocks and rising government bond yields. 10-year U.S. Treasury notes are now trading at a yield of about 2.28%. That's up about 7 or 8 basis points over the last 2 or 3 days, and it will likely rise even further as the market begins to get comfortable with the unwinding of the Fed's balance sheet. That could push tech stock prices lower, and that might be why the NASDAQ is looking a little bit heavier than the other 2 benchmarks today. We're going to follow that story and a whole lot more throughout the day. Please come back to TheStreet.com, but I want to say thanks for watching 5 Before the Bell, at the very least. I'm Martin Baccardax. I am the London Bureau Chief here at TheStreet.com. Thanks for watching, guys, and we will see you tomorrow.